In this video presentation, we're going to review some of the information that you'll need to construct financial statements, and then we'll practice constructing an income statement, statement of retained earnings, and balance sheet. The financial statements are prepared in a specific order because of their interrelationships. These interrelationships are referred to as articulation. The income statement has to be prepared first because you're going to calculate net income or loss on that statement, and the net income or loss from the income statement is needed to calculate the ending balance of retained earnings on the statement of retained earnings. Your balance sheet won't balance unless you have the proper ending retained earnings balance. So we calculate net income on the income statement first. It feeds into the statement of retained earnings, where we calculate the ending retained earnings balance, which is needed to make our balance sheet balance. Cash from the assets section on the balance sheet feeds into our statement of cash flows. We're not going to worry about the statement of cash flows in this presentation. We're going to be focusing on the income statement, statement of retained earnings, and balance sheet. So if you're given a set of financial information that you need to organize into financial statements, the first thing you're going to want to do is to go through and identify each of the accounts as a revenue, expense, dividend, asset, liability, or equity account. So we're going to identify our revenues and expenses and recognize that those are going to go on our income statement. We're going to identify the dividend account and recognize that that is going to go on our statement of retained earnings. And then we're going to identify our asset, liability, and equity accounts and recognize that those are going to go on our balance sheet. Revenue accounts are pretty straightforward. They're all going to say revenue on the end of them, and there typically will not be more than one or two. But in terms of expense accounts, there can be a number of different expense accounts. They all say expense on the end of them, except for cost of goods sold. So if you're a business that your business model is buying and selling goods, then typically cost of goods sold, which is the cost of the inventory that you sell, is going to be your largest expense. Other expenses include supplies expense, salaries expense, advertising expense, insurance expense, interest expense, and tax expense. Two expenses that we haven't really talked about, but which you may see, are depreciation expense and amortization expense. These two expenses relate to the cost of long-term assets, and we'll discuss them in detail later. Assets include cash, inventory, which we know are goods purchased for resale, supplies, which we know are goods purchased for use in the business. Accounts receivable is an asset that is the amounts owed to the business from customers. So if a customer makes a purchase on account, they owe the amount to the business, and that is recorded as an accounts receivable. Property, plant, and equipment is typically abbreviated PP&E. These are long-term assets, including land, buildings, and equipment. Investments are typically going to be the stocks and bonds of other companies, although there are other types of investments. And finally, intangible assets, which are long-term assets which lack physical substance and include such things as licenses, trademarks, and copyrights. Liabilities include accounts payable, which are amounts owed by the business to suppliers So if the business makes a purchase on account, they owe the business from whom they purchased the goods or services, and that is recorded as an accounts payable. Notes payable are going to be amounts owed typically to banks. If you borrow money, you're going to incur interest expense, and interest payable is the amount that is owed in addition to the note for interest. Salaries payable are amounts owed to employees, and unearned revenue is recorded when cash is received before the performance obligation is satisfied. So it is a liability, but goods or services rather than cash are owed. So to review again, revenues and expenses are reported on the income statement. Dividends are not an expense. They are a distribution of the company's profits to the shareholders. The statement of retained earnings will report beginning retained earnings, net income or loss, and dividends if the company declared and paid them. Assets, liabilities, and equity are reported on the balance sheet. So here we have a set of information, and what we want to do here is prepare an income statement, a statement of retained earnings, and a balance sheet. If you get to your balance sheet and it balances, then there's a good chance that you've done this correctly. What I would do at this point is pause the video, go down the list of accounts, identify what type of an account you think each of them is. So is it revenue, expense, dividends, assets, liability, or equity? Identify what financial statement the account is going to be reported on. So revenues and expenses will be reported on the income statement. Beginning retained earnings, net income, and dividends are reported on the statement of retained earnings, and then assets, liabilities, and equity, including the end of the period retained earnings, are reported on the balance sheet. Once you've done that, prepare the set of financial statements. Remember that you have to prepare the income statement first. You're going to take the net income or loss number and use it in the second financial statement and compute the ending retained earnings balance, which you're going to report in the stockholders' equity section on your balance sheet. So if you're feeling pretty confident, pause the video at this point and go through this exercise and prepare the financial statements. If you're not feeling so confident, I will walk through the types of accounts in the financial statements with you, and then hopefully you can prepare the financial statements. All right, so for my less confident viewers, building is an asset. It's going to go on my balance sheet. Accounts receivable, also an asset on the balance sheet. The next two accounts have the term expense on the end of them, interest expense and depreciation expense. Both of these are going to be expense accounts reported on the income statement. The next account, land, is an asset. It's going to be reported on the balance sheet. We are preparing financial statements for the period ending December 31, 2024. So the retained earnings number that's given here is as of January 1, 2023. That is the beginning retained earnings balance that is going to be reported on your statement of retained earnings. It is not the retained earnings balance that is going to make your balance sheet balance. You're going to need to compute that number on your statement of retained earnings. So this retained earnings number is an equity number, but it is only reported on your statement of retained earnings. Equipment, the next account, is an asset. It's going to be reported on the balance sheet. Accounts payable is a liability. It is going to be reported on the balance sheet. Salaries expense, an expense account, is going to be reported on your income statement. Service revenue is your revenue account. It's going to be reported on your income statement. Cash is an asset. It is going to be reported on your balance sheet. And typically, cash is the first asset listed in the assets section on the balance sheet. Common stock is an equity account that's going to be reported in the stockholders' equity section on your balance sheet. Note payable is a liability account that's going to be reported on your balance sheet. And the dividends account here is going to be reported only on your statement of retained earnings. So now that we've identified those financial statements and account types, see if you can put together a set of financial statements. So pause the video here if you haven't previously paused it and attempt to construct your 3 financial statements. So hopefully at this point you have prepared a set of financial statements. Here is what your income statement should look like. We've got sales revenue of $98,900. There were 3 expense accounts that total $55,700. So we're going to subtract the expenses from the revenue. The revenue number is larger, and we're coming up with net income or profit of $43,200. So looking at this income statement, we also want to note the heading on it. And we have the company name, we have the name of the financial statement, and then we have for the year ending December 31, 2024. So recall that an income statement is prepared for a period of time, and this one is reporting MICTERS Corporation's net income for the year ending December 31, 2024. So now we're going to take that net income number of $43,200 and use it in our statement of retained earnings. Our statement of retained earnings is also prepared for the year ending December 31, 2024. So we're going to begin the statement using the $63,200 number that was given to you as the beginning of the period retained earnings. We are going to add in the net income that we computed on our income statement, and we're going to subtract out the dividends. We're going to come up with ending retained earnings, or retained earnings as of December 31, 2024, of $90,800. That is the number that is going to go into the stockholders' equity section of our balance sheet and should make our balance sheet balance if we've done everything else correctly. So here is our balance sheet. In the assets section, we have cash, accounts receivable, equipment, land, and building for total assets of $310,400. We have 2 liability accounts. They both have the word payable on the end of them, accounts payable and notes payable, for total liabilities of $105,300. We've picked up the common stock account balance from the list of information that they gave us. We've used the ending retained earnings balance from your statement of retained earnings, and we have total liabilities and equity of $310,400. So hopefully you were able to put together a set of financial statements that resulted in a balance sheet that balances. If not, we're going to have lots more practice on that going forward.